You may have heard that real estate investors are eligible for the best tax breaks. Well, this isn't just a rumor. One of the reasons why this is actually true is because of a very specific tax loophole that real estate investors can qualify for. Today, I'm going to explain how this loophole can help you save or cut your tax bill by 50 to 100%. Let's dive in. To fully understand this loophole, you first need to understand the basic tax benefits of real estate investing. Here are the basic tax benefits of owning rental real estate. When you invest in real estate, you can lower your taxes by deducting many expenses related to your property, such as business travel, like visiting your property from time to time, interest on your mortgage, cost for advertising your property to get a tenant, repairs like fixing a leaky roof, maintenance such as lawn care or cleaning, or even home office costs if you work from home. But you can also include utility bills like water, electricity, property taxes you pay to the local government, fees for hiring a property manager, depreciation, and much more. Depreciation is a big deal because the IRS lets you deduct the full purchase price of the building itself. This is because the building tends to experience wear and tear over time, so the IRS lets you write off depreciation costs. Most real estate investors spread their deduction over many years using straight-line depreciation. When straight-line depreciation is used, you deduct the full building value over 27.5 years. For commercial buildings, it's over 39 years. So, for example, imagine you own a rental home with a building value of $1.2 million. In this case, you deduct the full $1.2 million over 27.5 years using straight-line depreciation. If you did the math, $1.2 million divided by 27.5, you'd get about $43,636 every year. This deduction would lower your taxes every year that you own the property until the deduction expired. The land value doesn't qualify for a depreciation deduction because it doesn't break down over time. Only the building value does. So here's why you need an additional tax loophole. With all these deductions, you might think real estate investors have no need to reduce their taxes even further. But there's a catch. There was a law created in 1986 called the Tax Reform Act, which created the passive activity loss rules. These rules were added to the Internal Revenue Code through Section 469. The passive activity loss rule splits business activities into two types: passive investing, like renting out your properties, and active activities, like your main job or business. Karlton, what's the problem with that? The problem is that these rules made it so you can only use passive losses to lower taxes on passive income, not on money from your day job or business. For example, let's say a dentist earns $400,000 a year from their practice and $60,000 from rental properties. Without a special loophole, they could only use real estate deductions to reduce the $60,000 of passive rental income. The other $400K is still their job that is taxed at ordinary rates, which limits the tax savings. This is a big problem for anyone who wants to use real estate investments to minimize their tax on their earned income. Back in the 80s, high earners like doctors and lawyers used real estate losses to cut taxes on their main income. The government noticed this and created the passive activity loss rules to slow this down. But it left a few loopholes open for real estate investors to get around the passive activity loss rules. One of the best of these is the short-term rental loophole. The short-term rental loophole lets you treat your real estate losses as active losses if your guest stays in your property for 7 days or less on average. Why? Because short-term rentals, like weekly rentals, take much more effort, way more work than long-term rentals where tenants stay for months and years at a time. The government recognizes this extra effort and allows these losses to count as active losses on the returns. This loophole used to apply mostly to people running hotel, motel-like businesses. But today, platforms like Airbnb and VRBO make it super easy to offer short-term rentals. Therefore, you don't need to own a hotel. Just list a house or an apartment online, and you can use this tax trick. However, keep in mind that if you are going to use the short-term rental loophole to offset 1099 or W-2 income with rental losses, you also have to materially participate in the business, and you have to participate more than any other person. The easiest and best way to meet the IRS's material participation requirements is to simply work in the business for at least 100 hours during the year and more than any other person. Make sure you log all of your hours working in the business accurately, just in case the IRS ever comes knocking and wants to see proof that you materially participated. Which means that if you have a handyman or a cleaning lady, you have to track their hours too. The good news is that for many people, 100 hours is completely feasible, and it doesn't have to be all at once. You can spread it out throughout the year. So this is how we supercharge tax savings over here, by accelerating depreciation. The short-term rental loophole is great, but you can make it even better with accelerating depreciation. By accelerating your depreciation deductions, you can deduct your building values faster than the usual 27.5 or 39 years. And you might be wondering, how is this possible? By doing a cost segregation study, you're breaking your property down into two costs structural cost, like the walls, the foundation, and non-structural cost, like carpets, lights, and appliances. Non-structural items can be depreciated on quicker periods of time, 5 and 7 years, and 15 years. This means you can deduct bigger deductions in the first few years, sometimes 30 to 50% of the building's value in the first 5 to 7 years. But here's a real example. Sarah's a lawyer who earns $300,000 a year. To build extra income, she buys a $600,000 condo and rents it out on Airbnb. In her first year, she earned $70,000 in rental income. Not bad. Now, at tax time, Sarah totals her rental-related expenses. Now, I'm talking about the repairs, the advertising, the insurance, property taxes, and mortgage interest. It comes out to 40 grand. Now, not including depreciation, she has $40,000 in deductions. To maximize her tax benefits, Sarah hires a professional to conduct a cost seg, a cost segregation study. The building portion over the property is 480 grand, and the land is 120 grand. Thanks to the cost segregation study, Sarah is able to accelerate 25% of the building's value, which is 120 grand. In year one, now her total deduction for the year is $160,000, which is comprised of $40,000 in operating expenses and $120,000 in accelerated depreciation. Because her Airbnb qualifies as a short-term rental and she materially participates, the IRS treats the income as non-passive, allowing her to use the full $160,000 in deductions against both her rental income and her law firm salary. Here's the impact. Her $70,000 Airbnb income is fully offset. The remaining $90,000 deduction reduces her $300K of legal income to $210,000. So, by leveraging a cost segregation study and the short-term rental strategy, both strategies, Sarah dropped her total taxable income from $370 to $210, saving tens of thousands of dollars in taxes all in the first year. So why does this strategy matter so much? The short-term rental strategy allows you to eliminate a massive amount of taxes in a very short amount of time. You don't have to spend 750 hours managing your properties. This makes it one of the best ways to save on taxes. It lets you lower your taxes on both your rental income and your main job or your business income. Some people cut their tax bills by 40 to 50% and they own an investment property. If you make a lot of money, you might need to buy more expensive properties or multiple rental properties to get bigger savings. But this is why we like to do tax strategy, where we layer strategies on top of each other. Now, here's an extra tip. To make the most of this trick, keep good records of your expenses and guest stays to prove your property qualifies as a short-term rental. Also, work with a tax expert who knows these rules, who knows how to leverage this strategy. Maybe they own real estate themselves. If you're new to real estate, start with a small Airbnb property and learn the business. Over time, you can grow your investments and tax savings. Platforms like Airbnb and VRBO are user-friendly, and they make it very easy for you to run your business on there. Plus, a cost segregation study is a one-time cost that you can pay, and it saves you money for years. It's a complete write-off. Even if you're not a real estate pro, this strategy is within reach. It's a game changer for anyone who wants to build wealth and keep more of their hard-earned money. That's all I got for you guys today. But keep in mind, Tax Free Wealth Challenge is right around the corner. This challenge takes place August 4th through August 8th. It is one of the largest digital tax conferences in the world. I put this event on. This will be my 4th year doing this event. I'll be teaching high-ticket, high-level tax strategies like this one and many others over the course of 5 days. If you're interested in learning advanced strategies I don't teach on my YouTube channel, I'd highly recommend that you show up for the 5-day challenge. Okay, that's it. That's all I got for today. As always, thank you so much for joining me, and I look forward to seeing you in the next video. Cheers.